Most Canadians think becoming a millionaire means you need to find the next Apple, Tesla, Nvidia, or Shopify before everyone else. You need to watch the market every day. You need to read earnings reports. You need to understand charts, interest rates, recession signals, price targets, and whatever someone on YouTube says is about to explode next week. But what if that is not the real path? What if the boring investor, the person quietly buying simple investments every month, has a better chance than the person constantly chasing the next hot stock? And what if you're already in your 40s and you feel like you started too late? That is what we're talking about today. Can a regular Canadian still build serious wealth in their 40s using investing apps, ETFs, and a simple long-term plan? The answer is not magic, it's not guaranteed, and it's definitely not about getting rich overnight. But the math may surprise you. Before we continue, quick disclaimer. This video is for general educational purposes only. It is not personal financial, tax, legal, or investment advice. Investments can go up or down, and your situation may be different. Always do your own research or speak with a qualified professional before making financial decisions. Now, let's start with the big mistake. A lot of people open an investing app like Wealthsimple, Questrade, or another Canadian platform and immediately feel overwhelmed. You see stocks, you see ETFs, you see crypto, you see charts going up and down, you see red numbers, green numbers, analyst ratings, headlines, dividends, and 100 different choices. And suddenly investing feels like walking into a giant grocery store with no list. You went in to buy bread and milk, now you are standing there wondering if you should buy frozen mangoes, protein bars, paper towels, and a giant bag of chips because they're on sale. That is what modern investing apps can feel like. The app makes it easy to buy, but it does not automatically make it easy to make good decisions. And this is where the trap begins. The trap is thinking that because investing apps are simple, investing decisions must also be simple. But they are not the same thing. An investing app is just a tool. A hammer can build a house, but it can also smash your thumb. The real question is not which app should I use. The real question is what behavior is this app encouraging? Because for some people, the app helps them invest regularly. But for others, the app turns investing into a casino in their pocket. You check it every morning. You panic when the market drops. You buy something because it is trending. You sell something because it went down. You switch strategies every month. And after all that stress, you may have done worse than the person who picked a boring, diversified ETF and did almost nothing. Here is the part nobody likes to hear. Building wealth is usually less exciting than people want it to be. Most people want the movie version of investing. One smart stock pick, one perfect moment, one big win. But real wealth often looks more like brushing your teeth. Small, repeated, boring, easy to ignore, but powerful over time. Let's use simple numbers. Imagine someone is 40 years old. They feel behind. They do not have $1 million. They do not have some giant inheritance. They are just trying to build wealth while dealing with Canadian rent, groceries, insurance, phone bills, car payments, maybe kids, maybe a mortgage, maybe aging parents. Now, imagine this person invests $1,000 per month. That is not easy for everyone. For some households, it may be too much. For others, it may be possible after debt is under control and the budget is organized. But let's use it just to understand the math. At $1,000 per month, that person invests $12,000 per year. Over 25 years, they contribute $300,000 of their own money. Now here is where compound growth matters. If the investments grow over time, the account does not only grow from the money they put in, it can also grow from the returns that start earning their own returns. That is compounding. It is not magic. It is just growth building on top of growth. At a reasonable long-term average return, $1,000 per month could potentially grow into a very large amount over 25 years. Maybe close to $1 million, maybe more, maybe less. The exact number depends on returns, fees, taxes, account type, timing, and market behavior. But the lesson is not, you are guaranteed to become a millionaire. The lesson is this: time and consistency can do more than most people think, and constantly chasing the perfect stock can do less than people hope.
Now, let's talk about index funds and ETFs. A stock is usually ownership in one company. An ETF, or exchange-traded fund, can hold a basket of investments. That basket might include hundreds or even thousands of companies depending on the ETF. So instead of betting everything on one business, you may be spreading your money across many businesses. That does not remove risk. The value can still drop, markets can still crash, you can still lose money, especially in the short term. But diversification helps reduce the risk of your entire plan depending on one company. This is why many boring investors use broad market ETFs as the core of their strategy. Not because ETFs are exciting, they are not. Nobody opens an ETF fact sheet and says, "Wow, this is more thrilling than a hockey overtime." But boring can be useful. Boring means you are not trying to predict which company wins next year. Boring means you're not betting your whole future on one headline. Boring means your plan is not destroyed because one CEO makes a bad decision, one product flops, or one stock gets too expensive. Now, some people say, why not just invest in brands I use and believe in? And honestly, that is a very human way to think.
You use the phone. You shop at the store. You like the coffee. You use the software. You see the company everywhere. So you think, this must be a good investment. But here's the problem. A good product is not always a good stock. A company can make amazing products and still be overpriced. A company can be popular and still have weak future returns. A company can be everywhere and still disappoint investors. And sometimes, by the time everyone loves the company, the stock price already reflects that excitement. So, liking a brand can be a starting point for curiosity, but it should not be the whole investing strategy. A better way to think about it is this. Your core should probably be boring, diversified, and aligned with your goals. If you want to buy a few individual companies because you understand them and believe in them, that should be a smaller, more careful part of the plan, not the whole plan. Think of it like food. A diversified ETF is the regular meal. Individual stocks are the spicy side dish. You can enjoy the side dish, but if your whole diet is hot sauce, things may get uncomfortable.
Now, let's bring this back to Canadians in their 40s. The scary feeling is that you are late. You see younger people talking about investing at 20. You see people online saying they maxed their TFSA, RRSP, FHSA, and somehow still had money left over after buying groceries. And you think, great, I missed the train. But starting in your 40s is not the same as being hopeless. It just means the strategy has to be more intentional. You may not have 45 years, but you may still have 20, 25, or even 30 years of investing life. And retirement is not always one hard stop. Some people work part-time, some delay CPP, some use RRSPs, TFSAs, workplace pensions, non-registered accounts, or other income sources. The point is not that everyone has the same path. The point is that giving up is usually the most expensive option, because the years will pass anyway. 5 years from now, you can either be 5 years into a plan or still waiting to feel ready. And most people never feel ready. They wait until the market is calm, but the market is never calm. They wait until they understand everything, but nobody understands everything. They wait until they have more money, but lifestyle costs usually rise too. They wait until there is no risk, but investing always has risk. So the real question becomes, can you build a plan simple enough to actually follow? Because the best investment strategy is not the one that sounds smartest at a dinner party. It is the one you can stick with when the market drops, when headlines are scary, when your app is flashing red, and when everyone online suddenly becomes an expert. Here is a simple way to think about the order. First, understand your budget.
You cannot invest consistently if your paycheck disappears every month and you don't know where it went. Second, deal with high-interest debt. If you're paying huge credit card interest, investing while ignoring that debt may feel like filling a bucket with water while there's a hole in the bottom. Third, build some emergency savings, because if every surprise bill forces you to sell investments at the worst time, your plan becomes fragile. Fourth, understand your account options. In Canada, that may include a TFSA, RRSP, FHSA, non-registered account, or workplace plan. Each has different tax rules, and the best choice depends on your situation. Fifth, choose a strategy you can explain in one sentence. For example, I invest every month into a diversified ETF portfolio for long-term growth. That's simple. It's not flashy, but simple is easier to repeat, and repeated behavior is where the wealth building happens. Now, let's talk about fees. Fees are boring, so people ignore them. But fees are like a tiny leak in your wallet. 1% may not sound like much, but over decades, small differences can become very large. That does not mean the cheapest product is always automatically the best for everyone, but it does mean you should understand what you are paying, whether that is management fees, trading fees, advice fees, currency conversion costs, or fund expenses. Because when two investments have similar goals, similar risk, and similar holdings, higher fees can quietly reduce your long-term return. This is why many people like low-cost index ETFs. Again, not because they are exciting, because they can be simple, diversified, and lower cost. Now, here's the emotional part. A lot of Canadians do not fail at investing because they picked the wrong app. They fail because they keep interrupting the plan. They start investing, then the market drops. They stop. The market rises. They come back. A stock goes up, they chase it. A stock goes down. They panic. Someone online says there is a recession coming. They sell. Someone else says the market is about to boom. They buy again. And after all that movement, the biggest cost may not be the fee. It may be the behavior. This is why boring investing can be so powerful, because boring helps remove the drama. And the less drama you have, the easier it may be to stay consistent. So can Canadians become millionaires using investing apps, ETFs, and a boring plan? Some can, some will not. It depends on income, savings rate, debt, time, returns, taxes, fees, and life events. But the important lesson is this. You do not need to spend every night researching stocks to become a serious investor. You do not need to predict the next winning company. You do not need to turn your phone into a stock market slot machine. For many people, the path is much less dramatic. Earn, spend less than you earn, clear high-interest debt, invest consistently, use tax-advantaged accounts wisely, keep fees reasonable, diversify, and give time enough room to work. It sounds boring, but boring is not the enemy. Boring may be the reason the plan actually survives. So before you chase the next hot stock, ask yourself one question. Am I building wealth, or am I just looking for excitement? Because those are not always the same thing. If you found this helpful, subscribe to New Canadian Wallet for simple Canadian money explanations without the confusing finance talk. And comment below, would you rather invest in individual companies you know or keep it simple with index ETFs?